Welcome back to Wealth Mavericks, the podcast where we help doctors unlock the secrets to building generational wealth. And today we're talking about the real cost of your bills and what you can do to change it.
It's going through the tax man's hands first, so you're already losing whatever your tax rate is on those dollars. As an individual, what's the largest expense? What's the first expense we pay? It's the tax man.
Bob, you recently walked our team through some crazy math, and it's something that I hadn't considered, and I'm sure a lot of our listeners haven't considered. You asked us, if you're a high income earner and your mortgage is, say, $5,000 a month, how much income do you need to earn to pay that mortgage each month? And if you're in a 37% tax bracket, the answer was you need to earn almost $8,000 just to pay the $5,000 mortgage. And so then we began talking about how does that impact every bill you pay? The highest amount of taxes, now you have 63 cents on the dollar to be then paying all those bills. So I wanted to talk about this crazy math that you shared with us and what can we do to shift this into being the business of you, and how can we change that math? So talk to me about how taxes change the real cost of a dollar, especially if you're a W-2 earner.
Yeah. Well, this is certainly something none of us learn in school.
Mm-hmm.
This is something we only learn because we read something, heard something, or we researched something. And when you think about this, everything we do, every decision we make for our members is thinking like the IRS. So if you want to, in anything, you want to be a better athlete, you're going to look for the best athlete that is what your position is or what you're doing, right? And you're going to want to mimic what they do or a group of those individuals, right? Nothing's different than us as workers or doctors or taxpayers. So if I'm a taxpayer and I want to reduce my taxes, I need to understand how people who pay less taxes do it. And it's not because they have a separate tax code. We all have the same tax code. The difference is they do this with a business owner mentality, because that's how the tax code is written for a business owner mentality. The government is a business, and their revenue, not their income, their revenue is our taxes, is what they earn as a business. So for us, if we were to flip that and say, okay, what's your income? Well, then you're thinking as an individual. But if I thought about it as a business owner, it wouldn't be what's your income, it'd be what's your revenue. Okay? And the reason being is, as a business, the way the tax code's written, your revenue and then the cost of doing business is your expenses. And then after that is what you have left over as profit or loss. That's the profit and loss statement for a business. Flip it to an individual, I'm earning income, and then I have expenses also, cost of living, and then I have discretionary income, which is what we call profit on the business side. So what makes up those expenses as an individual? What's the largest expense? What's the first expense we pay? It's the tax man. Right? So we make income, so W-2, and they withhold our taxes. So we get a net amount that gets deposited into our checking account. And then from there, we live our life, pay our expenses, and then we have discretionary from there. Okay, that's the process. Mm-hmm. So if I looked at that from a business owner lens, then how do I view income as cash flow when it comes to things like my mortgage, things like eating out, things like groceries, my vehicle, etc.? Then I have to think about the top line expense that comes out right off the bat. Meaning, to your point earlier, you said, hey, if I have a $5,000 mortgage payment that's coming out of my checking account, where did that money flow from? My paycheck through the tax man's hands. So that taxes was taken out to net the $5,000. So if I looked at all my expenses that way, then all of my expenses have a tax consequence to them first. Plus inflation, the silent killer of the cost of living.
Mm.
Okay. So when we look at these things, our expenses with taxes and inflation, this is why I wrote the book, Economic Termites. It talks about these two things, right? And then time. Every year that passes, we can't recapture that. That's a cost that deteriorates our wealth, specifically for doctors when they give up a decade of their life and they're in their earning years 10 years after most people.
Mm-hmm.
Right? How do we make up that time? And then the last termite is laws and regulations, our politicians, the laws that are enforced. How do I call that the queen termite, right? Those are the ones that affect everything we just talked about.
Hmm.
Okay. So this is our spending is the driving force of our tax consequence. So if I'm a W-2, well, Bob, I make a $800,000 W-2. I don't have control over that and how I get paid my 800,000. Well, no, you do. You actually negotiated that. The two parties, your employer, you said, I'm valued this. I see value of this, and you agreed to 800,000.
Mm-hmm.
Right? Now, I'm not saying negotiate lower so you pay lower taxes. That's insane. I'm not saying that. I'm saying that's how that comes. But your expenses before that 800,000, now all of a sudden have they crept up because your income crept up? Right? Do you go to nicer restaurants? Do you have a nicer car? Do you have a bigger house? Do your kids go to nicer schools? Do you have nicer clothes? Those are all expenses that are driven off of you because your income's higher. So you have less discretionary income. Why is this important? Because all those things pass through the tax man hand. So if we shifted to a business owner mentality, okay, and we set up a business, and the whole point of setting up a business is to make money. That's what the government says. If you're going to set up a business, you need to be in the business to try and make money. They didn't say profit is a requirement. You need to try to make money. What's the success rate of a business year one going into year two? It's like single digits. Is that a statistic that Aaron and I came up with and we're like, hey, this success? No, this is a government statistic. They tell us, they track us. They track that. So don't they know that as a business owner, you don't necessarily make profit year one? That it is an investment in an asset. Why? Because they're a business, the government, and they invest in business owners as assets because they create tax revenue, employees. Okay, it just follow the process. So let's use an analogy, and I do this analogy in my book, Farming Assets. Let's imagine we plant a orange tree. Okay, well, when we plant an orange tree, it's just a little sapling. That first year, it's not going to create oranges. So so you just pull it out and throw it away? No, you nurture it, you water it, you take good care of it, and it grows and expands. And then in the next year, it may have one or two fruits, and then so on and so on and so forth, to where now every year it's providing fruit. Now, some of the fruit is better at different parts of the tree, right? That's you. You're that tree. Who's the farmer? The government. They planted you. So they know you as a business, you're not going to yield fruit right away. But if you think like a business owner and you're investing, you're trying to make money, eventually you will. So if we think from a business owner perspective, so then how do I gamify my income? How do I gamify my expenses? And that's what we need to do. And this is the process that we talk to our members about. And this is the process of the cash flow map. Okay. The cash flow map is to acknowledge discretionary funds, what we call dormant dollars, dollars that are sitting on the couch eating potato chips. They're not doing anything for you, right? We want them off the couch, go mow the lawn, go paint the house, go buy a piece of property or whatever it is, right? You're not allowed to sit on the couch and eat potato chips. You have to work. I worked hard for you, right? Kind of conversation we parents have with kids.
Totally.
Right? And because they don't know. Your dollars don't know. They're only doing what you tell them to do. So if you say nothing, if you tell your kid nothing, what are they going to do? Nothing. That's the psychology of it. So we know better, so we give them direction. So when we gamify cash flow and understanding, where am I spending? Not because we tell our members don't spend money. Hey, you work for it. It's your money. But you should know the consequences to your decisions of that, good and bad.
Mm-hmm.
But understanding that it's going through the tax man's hands first, so you're already losing 35, 37%, whatever your tax rate is on those dollars. So we set up a business. Now what we need to try to do is try to make money. What's that look like? Well, that's really dependent on what we do with our members, what their situation looks like. And that's why we go through an asset map, right? Same thing. We go through existing assets. But the cash flow map, we find certain expenses. Now that you're a business, are those expenses qualify for the business? Are those expenses that are deemed things that are helping this business to make money? And the answer is yes, right? So right now you are in a office space. I am as well. And I pay a mortgage payment, right? I have internet payment. I have utility payment. I have insurance payment, so on and so on and so on. Well, a percentage of those dollars now are equated to an expense of the business. Okay. And so those personal expenses now become business expenses. Now, this is dripping faucet money. And what I mean by that is, like, it's like any dripping faucet. It's not going to make a big deal. But if the sink is plugged and that faucet's dripping, not handled, it's going to cause an issue and some damage.
Mm-hmm.
Same thing here, is that these are dripping. So if we don't focus these into the right direction to help you, then it's just going to keep causing damage. Okay. Now, when we focus in this stage, in this area, we find our members start gamifying their own spending. So can I share a couple examples of what we've seen with some of our members?
Yes.
Great. So, and it falls anywhere in between these two examples, but I'll give two examples. One example I'll give on members who decide that they want to actually spend less money. They've looked at it and go, you know what, Bob, you're right. We've got 3 kids, so it's a family of 5. We go eat out about 3 to 4 times a week. Well, depending on where you live, that's easily $100 bill.
Or more. Yeah.
Right? Or more, right? And every waiter and waitress, right? What's the default 18%? Mm-hmm. When it used to be 10% just 5 years ago. I'm not sure where that 8%, it's not like they're working harder, right? They're not running through the restaurant and giving my food better. It's right. My food doesn't taste better because of that extra 8%. But that's a different conversation. But it's your car.
Because I'm not sure 10% was ever a good tip, but I was a waitress back in the day. So, but the point is, it really adds up when you take your family out.
It adds up. And if you're doing it 3, 4, 5 times a week, it adds up. Knowing that now the tax man took their share first. So that $100 bill plus 37%, times 4 or 5 times. So here's what they've done. So some of the guidance are like, well, Bob, we noticed that we eat out a lot. What do you recommend? And I say, make eating out meaningful. What's that mean? Well, maybe the 2 of you do date night every other week. So you have time by yourself. You guys go enjoy your time. But then you do maybe once a month a fun dinner with the family. And you make it, this is May Day dinner, right? And we celebrate May, right? This is, June gloom dinner, whatever you want to call it. You guys make it a tradition in your family. And get the kids excited about it. Everyone think about what you want to eat. What do you want to do? And make it a fun event so they look forward to it, but it's one time a month, right? And that becomes more cost effective. Now, Bob, you're saying that probably really only save about $300-400 a month. That's great. That's $3,600 to $4,800 a year. if you could earn 15% return on that, or it reduced your tax liability by 37%, isn't that worth it?
Mm-hmm.
And everybody's enjoying it. You've made it meaningful. So that's what some of our members have done. They've just kind of repurposed how they spend. They don't stop spending, right? Or we say, actually, take that extra money and put it into a vacation. Create some R&R, create some rest and relaxation, bring some peace to you and the family by doing things together, creating memories. There is no cost to a family trip. I mean, it is 100% value in those memories, that experience. It's priceless.
Mm-hmm.
It's priceless. But you become a better doctor, you become a better dad, you become a better mom, you become a better kid because you have that. So it could be the same expense, just shifted in different areas to create a different return, right? That's valuable. So that's what some members do. The opposite side is when we have members that go, we have other members that on the opposite side that they're like, well, Bob, we don't really do all that stuff, right? We live a very comfortable lifestyle, but we don't overspend, right? We love eating at home, blah, 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 all that kind of stuff.
Mm-hmm.
So then the question is, well, what do we do to increase that money? Well, some of our physicians have the ability to take on a couple extra shifts, not a week, but maybe a month. Hey, take up what would it increase your income on a monthly basis if you picked up 2 extra shifts a month? Oh, that would be X amount. Okay, great. So then that X amount we put into an asset. We put into your building your business plan, right? Trying to make money, that part of it, right? So we have members in between. Mm-hmm. Right? And that's really the goal, is being thoughtful and mindful of what you're doing, because overall, a period of time, what we're doing is like planting the fruit tree, planting the orange tree. Over time, we want it to bear fruit, but we want it to be juicy and good, not rotten and bad, right? And so the only way we can bear good fruit is by being involved in it, being mindful of it, being in control over it. And that is what the cash flow map does. It is all about you. Your goals are your goals. They're not Aaron's, they're not mine, they're not anybody else. They're your goals. So our job is to help you think about, how do we attain those goals in the most efficient way, and time frame as well. Not just a dollar perspective, but an efficient time frame as well. Mm-hmm. And that's what the cash flow and the psychology of the cash flow map is supposed to do.
And some people might be listening and think, I don't want to do either one of those. I don't want to cut back. I don't want to take, and that's absolutely fine. Like you said, it's all about you building the business of you. But what we're here to do is help you put the focus there, because we talk often about how we see that as your income goes up, if there's no plan for those dollars, then they just get absorbed into your lifestyle. And then at the end of the year, you look back and you're like, where did all of that go? Mm-hmm. And so providing that clarity, again, not going to tell you how to spend it, but look at what's possible. No one's ever showed you what more is possible. You know, you're living the life you want to live. You're saving for your future. Now you've got this, like you said, profit or this discretionary income. Where do I put it? Is it just sitting on the couch? Is it going into something that maybe isn't going to give me the fruit I want to give, but I don't know any better? And so that's what we really help people do. And I think when you help people put that focus on, how much does this actually cost me when I'm paying so much in taxes, it just gives even more of an urgency, I think, to taking you down in the tax, what's it called? The tax brackets.
Yeah.
Because then it impacts literally every expense that you have.
Yeah.
So I really appreciate you helping us understand that.
Yeah. Well, it's important too, because then this conversation and the cash flow mapping leads to the asset mapping. So then it comes to that conversation is, I have dollars sitting in my savings account, and we have a handful of members that are like, look, Bob, I've got 300,000 sitting in cash, and I don't want it sitting in cash.
Mm-hmm.
And so what do? What they've always done, and a lot of times is just put money into the stock market. They're very risk adverse, but they feel like they need to do something because in the savings account they know it's not doing much, right? So then they make a decision out of kind of desperation.
Mm-hmm.
But then what happens if the market or economically things go down? You're taking now risk on dollars you didn't want to take, but you're doing some, and so now it's no different than the tax expense is the loss expense, the risk expense. What's that look like?
Mm-hmm.
Right? That's your hard-earned dollars that you already paid 37% on. Then now you're risking it into a potential lower, right? So what do? How do we, and that's where the asset map comes in. So I have extra savings and discretionary funds, and we found these dormant dollars on the cash flow map. Now where do we put them?
Mm-hmm.
And that's the correlation between the two. And that's what creates the execution of the tax plan and the plan to reduce your taxes, because of we're focusing on the right assets in the asset plan to create that lower tax liability. And that is the business of trying to make money.
It's so good, Bob. I'm just so impressed by every step of the process that you've put in place. And I know I get to see it every day. Our members are so impressed too. So as you're talking, I'm thinking, I want to do something different here. For those who are listening on YouTube, you can comment and tell us if there's another topic you want us to talk about. We've had a few of those, which is fun for us. I have it in my plan here. But two, if this conversation resonates with you and you're like, yeah, I need more clarity on this, we actually recently put together a piece that shows you every question you might have and how every step of our process answers a different one of those questions. So comment the word clarity below, and I personally will send you that so that you can understand, as you listen to these conversations, what does it actually look like that we're able to do in your life to help you begin building the business of you, paying less taxes, and then literally using those same dollars to put into assets to hockey stick the growth of your wealth. That is what we are all about. So, Bob, I really appreciate everything you do, how you explain things so well. I think this was a really good conversation. Doc, thank you so much for listening. We look forward to talking to you again. Until then, go be a wealth maverick.